Hi guys, Harry Yotis here, professional trader for 20 years now. Started my career in 2005 and still alive in 2026. Okay, today, first day of May 2026, this candle right here on a chart of the S&P 500. Yes, the big news is we are squeezing to new highs. This is the squeeze from hell, okay? But if you listen to the media, you would think that we're in trouble because you're still getting very negative news, not like constant barrage of negative news, even as the market is going to new highs with nary a pullback. Would this be considered a pullback? Probably not. Okay. They're going to tell you all kinds of stories that it's wrong, but it is right. Okay. This is correct. We are squeezing to new highs, and I'll tell you what the implications are and how you guys should view this move. Okay. Don't look at whatever others are saying. Okay. You have to use more of a critical thinking lens before jumping on the bandwagon of fear. Okay. Because this is a very, very strong bull market. Okay. We'll get to this squeeze to new highs and the implications and what I think going forward, as well as some trade ideas going into the future and what I expect to see later on. But first, let's talk about the technical picture. Bullish, guys. We don't even have to put any moving averages. Forget that. You could just see clearly the action. And if you see it intraday, it's very, very strong as well. Although it might be sort of slowing down a bit for now. Okay. So technical picture is bullish. We're at new highs. We close at new highs. If anybody tells you otherwise, they don't know what they're talking about. Okay. So we always pair it with sentiment, our analysis that is. And 67, we're still in greed. Okay, we're not even at extreme greed yet. Okay, the sub indices are, the momentum has always been in extreme greed, but the strength and the breadth, and look, the put call options are still at fear. People still buying puts because there is fear out there. You're hearing a lot of fear. Okay, a lot of fear going on, despite the fact that these markets are at highs. Okay, and that's the whole point of this thing, that the sentiment is there, but greedy, but it doesn't feel that way. It feels like the people are still cautious, still 1 foot out the door in this market. Still a wall of fears, I'm concerned, even as we're in greed, okay? And yesterday we had the AAII investor sentiment survey. I didn't bring it up. We're going a bit too long. And look, as we mentioned last week, yes, we had the first time it's bullish, but then we start, anything that happens, any kind of bad news, any whatever, the bears are going to come in because it hasn't been solidified. You need to have this solidified. It's not. Look, the bears are back to attack. 39.7% bearish and just 38% bullish, which is basically average. You didn't even have 1 week of extreme bullishness. This is why we have a wall of worry. Okay, this is telling you exactly it. The bears have never retreated. They are still there. You're still getting bad news everywhere, and that's what's fueling this bull market higher. So be wary. Don't fall for the hype. Look at what's actually happening. Okay, so that's it. We have sentiment that's bullish yet negative. Bullish negative. We have greed here, but people are not believing it. And we have, bears coming in at 40% here on the AAII investor sentiment survey. So you have a lot of people worried that this market is ripping higher with not a pullback, of course. Okay. So before we continue to squeeze to new highs, we have a macro print, the ISM Manufacturing. And look, it came in at 52.7. Last month was 52.7, expanding at the same rate. But like we said, you wouldn't know it. You wouldn't know it from places like Zero Hedge and the markets. We have posts like this. In the morning, the manufacturing ISM misses as prices surge most since April. Employment slides to employment of the ISM manufacturing employment. They have a number of sub-indices in the ISM manufacturing. We always look at the headline number. But there are sub-indices like new orders, prices paid, employment, and employment slides. So they're emphasizing that employment is down and that it's a miss. Why is it a miss? Well, because here we got a print of 52.7, but they were expecting like 53 or something like that. Okay, they were expecting higher, but it doesn't matter. This is like, who cares? 52.7 versus 53. The point is, as long as it's above 50, the manufacturing sector is expanding. It's just the rate at which it's expanding. Is it expanding fast, slow? But this is an expansion of 4 weeks in a row. This is good news. Okay, look at the 10 years. Look at the last time it was at 50. We mentioned this a while back, 52. It literally was in 2022. Okay, and it was going down. Okay, it's coming up. We're like it's from a 22, 23, 24, 25, like 4 years of contraction because it was below 50. That's contraction. It was getting smaller and smaller, and now it's starting to expand from lows. Okay, this is very, very positive for the manufacturing sector. Yet here, look at the spin. Prices surge. Yeah, well, we know that prices are surging. Okay, we have the PPI to show us that, producer price index. Okay, and look, employment slides, doesn't matter. Okay, as long as production and productivity is going up, the economy is going to go up, and the market is going to reflect that. So, squeeze to new highs. We're having it with bad sentiment, if you will, and sentiment spills over to the ISM manufacturing. They're trying to spin it as something bad. So it just goes to show you that we are not at the highs of these moves yet. Okay, so let's get to the main event. Why are we not at the highs? Okay, squeeze to new highs. This is killing the bears that were caught short here. Destruction. Okay. Now, everybody's like, if you go to Zero Hedge, okay, just give a cursory look of Zero Hedge or even CNBC, okay, you will see it. It's the same thing, okay. Stocks hit, look at that, stocks hit fourth all-time high of the past 5 days, with many stocks falling then rising. Okay, they have to make a negative, bad breath. It's tough to say. No, they're saying stocks are rising on bad breath, not breath. Not on bad breath, on bad breadth, okay, which another negative, okay. Goldman warns crash risk spiking as market breadth plummets to .com bubble lows. Who cares? Okay, this is complete garbage because look, okay, this entire bull move was on bad breadth. Here, 2024, we had the big move on just the Mag 7. Remember, everybody else sucked. Right? Bad breath. Look, this whole rally for 2 years and going bad breath. Okay. See, it's just anything to fear. There's no euphoria. There's no euphoria. Even though we have the few ingredients that greed, it doesn't feel like we're in greedy times. Okay. So you're going to get all of this bad news coming. Okay. Where is it? Whatever. Okay. Gold. Trump says Iran. Okay. Let's get to another bad news here. More Iran bad news, okay? It's the same thing. What else? All-time high, negative breath, the same thing, okay? Always is war, negative breath, something bad about, there's always something bad, okay? We're not going to go through it. It's pointless. I'm just telling you that it's always something bad as the market's going up. That means we're not at highs, okay? And I'll leave you guys with a final thing here. The final topic is that everybody's quoting the PE ratio, okay? The PE ratio is at 21, okay? Let's see here. PE ratio of the market is at 21. And historically speaking, that is equal like 1% growth for the next 10 years. 10 years going forward, if we had a PE ratio of 21, we get 1% anemic growth, okay? So that's why people think it's going to tank. However, this is historical PE. If you compare it to the forward PE, a PE of 21 results in about a 6% yearly growth. That's okay. It's not amazing. It's just barely keeping up with inflation. Okay, it's not 9% like it was historically, but it's not a crash level. And we all saw the macro data in the past where the initial claims are holding up, GDP is going at 2-3%. It's just chugging along. Okay, so 21 is 1% historically, but if you look at the forward PE, let's say F forward 21 PE, we should expect 5 to 6% growth, which is decent. Okay, it gets troubling when we get to the forward PE of like 25. Okay, which we're not there yet. Okay, 4P of 25 would equal like maybe 1% to 2%. Okay, and it gets really bad above the 4. If we get to 30, it's negative. Okay, and then we have to start worrying. When we get to like a forward PE ratio of the S&P 500 of 25, then we're getting overvalued. Okay, but do you know at what level a 25 PE ratio on the S&P 500 translates to, or the SPY? Okay, well, I'll tell you right here. About 850 on the SPY. A long way to go to 850. This market's going to go up and down, up to 850. People are going to say it could go to 800. and it'd still be decent. That would be 25 when it gets to that. When it gets to when it gets between that, we can easily get to 800. 750 or our target 770, which is a 10% move higher. We can easily get that, guys. Okay, so don't look at the Cassandras. Don't think you're going to be the next Michael Burry to pick the top. You're not. Even Michael Burry isn't the next Michael Burry. Okay, so what I'm just trying to tell you guys is that ignore this fear. The numbers could play out. The 4P ratio, and the reason why historically is different than the 4P ratio is because we're in a higher growth environment in terms of AI and all that. Okay, so any way you want to look at it, okay, a P ratio, 4P ratio of 21 is decent. We're getting a 5 to 6 to maybe 7. Let's say an average of 6% because the range is 5 to 7. So an average 6% return per year, inflation of 3%, whatever, you're making 3% net, or inflation of 4 or 5, you're still making a net return. It's not amazing as it was before, but you're still making a decent return going forward. Not enough to crash this market, okay? And the market's certainly not going to crash when you're getting to these levels, okay? And I'm just waiting for a pullback to go long. I'm not getting long yet, okay? But I'm going to leave you guys with one trade idea, okay? Here, Trump says he's raising the EU auto tariffs to 25%. I don't know how he's going to do it, but the stock that I will look for in terms of playing this game is Carvana, okay? I'm not doing anything Carvana because they're going to split coming up next week, next Friday, the 8th of May. So I'm going to wait after the split before entering a Carvana trade. And I'm probably going to do an options trade like we did with Tesla. Okay. I'm going to sell a call, sell a put. It's called a strangle. And I'm going to see what the skew is. I'm going to keep you guys informed because this video is getting a bit long. But Carvana is the trade idea that I'll be looking at and trying to enter a strangle. Okay. Well, just a quick look. I had Carvana up. Yes, I had Carvana up and I put it up. Okay, if you're going to do this, I'm looking here, options, strike price, calls here, puts here. If you're going to June 48 days on Carvana, I'm looking at the 320, 500 strangle. Okay, I want to sell the 320 and sell the 500. Do you see the price right now is at 382, which is right here, 380? Okay, 380. Look how close the put is compared to the call. This is called positive skew. Everybody thinks Carvana is going to go up. Everybody's buying calls on Carvana. So that's why it's so far away, and I want to take advantage of that, okay? And it's a decent enough volatility. 60% volatility is pretty good, okay, to enter this trade. I'm waiting till after the split, but at a 380 price, you're going to get literally $16.50 to maybe $15 per share. So for one contract, you're getting $1,500. And then you can mitigate it as it goes along. But so far, this is what I'm looking at, but not right now. I'm going to wait because I think we might get this market to pull back a bit, squeeze less. I don't know what it's going to look like, but it would be lovely to retest these highs. Okay? All right, guys, I'll see you next week. It's been a crazy April, and May is coming in strong. Later.